Thank you very much. Well, good evening, everybody. And my name's Andrew Bell, and since 2010, I've been in charge of the team at Witan as chief executive officer. And so it's rather too late for me to blame anybody else. Like Ryan, I could wax lyrical about the slides I'm about to go through, but there are quite a lot of them, and obviously AJ Bell, no relation, unfortunately, is going to send them on to you afterwards so you can peruse them in detail, and I will quite happily pick up any questions we can't cover today if you send them to contact@witan.co.uk. So I'm just going to try and pick a couple of points out of each of the slides, and accept that that may be a little bit too much detail for those who are very familiar with Witan, and possibly just a little bit too little if I might be glossing over things for those who are new to us. But here goes. Witan, in summary, is a global investment trust. We invest in global equities. We've got assets of approximately 2 billion, which is obviously enough for most people's portfolio, but the point is we're relatively liquid. Most of our shareholders are private individuals or people managing portfolios on their behalf. So we have a private client mindset, not an institutional mindset. We have a multi-manager approach, which means we choose a range of external managers to do the stock picking for us, and then we try and cover the management of gearing, asset allocation, and more specialist asset categories using the in-house team. And our objective is to achieve better returns than our global equity benchmark, and within that, to deliver a growing income for our shareholders. Going back to what Ryan was saying about core and satellite, about 3/4 of our portfolio is allocated to managers that we view as mainstream equity managers. It doesn't mean that they're humdrum. So they have, say, the global managers we have anything between 20 and 80% in the US, and between 3 and 33% or so in the UK. So they follow their own investment methodology and according to where they find the best stocks. But 3/4 or so of our portfolio allocated to core managers, most of whom have a global investment remit. We have one specialist UK manager, and within that. The other quarter of the portfolio is intended to give us the ability to invest in more specialist areas if we think that the timing is particularly good for those areas. Two examples at the moment would be emerging markets, which did very well last year, have had rather a dull year this year. We think they may have attractions for contrarians over the coming 12 months. And we also have about 5% in a climate change specialist fund. So one category is we can have specialist investment managers for different regions or different sectors. The other area is that we allocate money to specialist investment companies in asset categories where a mainstream investment manager may not feel specialized enough to look at them, or may not view them as part of their investment universe. Property might be one example, distressed debt, listed private equity, and I'll come on to that in a little bit of detail later on. This rather involved slide, sort of pictorially, but graphically and also in words, describes how our investment process runs and some of the detail. It's too much to go through at the moment, but in a nutshell, the Witan's board chooses our external investment managers, the stock pickers, but that's after a substantial period of, we cast the net relatively widely to get candidate managers. We go through an extensive program of due diligence to check on their professionalism, their resourcing, and their credentials as responsible equity investors. And we appoint them with the intention of sticking with them through multiple economic cycles, because it's quite expensive to change, but we are prepared to change if we need to. One of the benefits of having a multi-manager structure is that if you need to change, you're talking about potentially changing 5, 10, 15% of your portfolio, which is a less traumatic thing than a sort of 100% change from a single manager. So it's easier to contemplate. But so in the end, we're long-term investors with our managers, but we do hold them to account just as our shareholders hold us to account. Apart from the stock picking, the management of gearing and asset allocation and more specialist areas, as I mentioned earlier on, is the responsibility of the in-house executive team. And our objective is, in the third column, to make our shareholders money. There's a long-term absolute return objective, but in the near term, absolute returns are going to be variable because equity returns are variable, and we aim to beat our equity benchmark over the medium term and to deliver a growing income to our shareholders. ESG is a new name for a set of principles which have been baked into investment management for a long time. The E part obviously refers to the environment, but it's an example of the sort of risk that investment managers should always try and take account of, the risks to the business models of what they're investing in, whether that be technological change over the last 10 or 20 years. At the moment, clearly, changes in climate are directly threatening some businesses. Changes in regulation of fossil fuels are imposing requirements, justifiably in my view, on other businesses. So companies need to be responsive to those, and investment managers need to be aware of the risks. The social responsibility and governance side, being the other part of the S&G, are, in our view, also an integral part of investment management and delivering decent returns for shareholders. They're not a sort of post-it note or an afterthought. And all of our investment managers and Witan as a company directly are signatories of a thing called the UN Principles of Responsible Investment, which is a detailed a code of best practice, if you like, where signatories also have to report to the PRI every year and be assessed as to how they're progressing in meeting those principles. And after the first year, those reports are public. So we're accountable to them and will be examinable, as it were, by the public on these matters, just as we and our investment managers hold our investee companies to account if they hit the news headlines for the wrong reason. The breakdown of our managers shown in this table here, I won't dwell on it in great detail. The blue ones are effectively the mainstream managers, the pink ones are the specialist managers. There's a little green thing, which is an exchange traded fund, which we used as a temporary asset allocation tool to boost our exposure to the US, which is now almost entirely sold. The size of the allocation to the managers depends partly on how long we've had them, partly on how specialist the mandate might be. For example, Lindenwood is a specialist technology partnership based in San Francisco. We wouldn't expect to have 20% in that, whereas the likes of Lansdowne, Lindsell Train and Veritas are more mainstream equity managers. So we vary the allocations a little bit opportunistically, but we don't trade it around, because the purpose is for these managers to find good companies that are going to deliver returns for our shareholders over time, and you can't do that if you keep chopping and changing. Looking at some of the aspects of our investment portfolio, this is a very busy slide. It shows different ways of slicing and dicing the portfolio. I hope everyone has fun examining it at leisure, but what it conveys is that we have a widely diversified portfolio, both geographically and by sector. No particular style bias, but if we have a bias, it's to be on the growth at a reasonable price sort of end of the spectrum, rather than either deep value or ultra high growth. And just a couple of slides following show that in a little bit more detail. This slide shows the geographic breakdown. Arguably, geography is less important than the companies that you buy within those geographies, but for what it's worth, the UK we have about 21% in, which is slightly higher than the 18 in our benchmark. And the reason for that is that our managers have found an unusually large number of what they believe are undervalued stocks in the UK. And for similar but opposite reasons, North America, just under 40%, is about 10% underweight against our benchmark weighting, because a lot of our managers feel that the market as a whole is expensive. They can find equivalents more cheaply elsewhere. Obviously, that hasn't worked so well in the last few years because the US has some of the leading world technology companies. There aren't always substitutes available. But if the recovery now broadens to something a bit more widely spread geographically and by sector, then some other markets have probably got less optimism baked in. We'll see. And this sort of polo mint chart or polo fruit chart shows the sector breakdown. And the main point coming out of that is that it's widely spread across a lot of sectors. Ryan was commenting earlier on about one-stop shop, and that is one of the things we try and do, not because we don't want people to think that we're fossilized and too boring, and therefore that's why we're just one stop, but we manage as many aspects as we can of the portfolio very actively, but we do cover a wide spread and a wide diversification. So people should have a less rocky ride. Doesn't always work, but it should have a less rocky ride than with a more focused portfolio. Worth emphasizing that both the geography and the sector mix are driven by the individual stock decisions of the managers. There's no sort of preordained plan. I mean, a template, templates are useful if you're having a dinner party, but not otherwise. Moving on, one of the things that we do that's relatively unusual within the investment trust sector is have an actively managed allocation to specialist investment companies. And we do this to access specialist asset categories, as I mentioned earlier on, that may be just off the radar of a conventional equity manager. And we have at the moment just under 11% of the portfolio in this particular slice, of which the largest component is listed private equity funds. The top 3 holdings there are all listed private equity funds, amounting to about 60% of this particular portfolio. And the rest is spread between a number of healthcare funds, a property specialist, and so forth. And the reason that we have developed this over the last 10 years or so is because myself and my colleague have a degree of experience in following the investment trust sector, which we think gives us, I mean, we're humble about it, because as soon as you think you've got an edge, then that's when you're probably going to get complacent. But we think it does give us a knowledge edge. And over the 10 or 11 years this has been going, it has delivered better returns for our shareholders than our benchmark and Witan as a whole. So we keep on doing it. If it hadn't delivered those returns, we wouldn't do it. We would allocate the money to the external managers. But that is an unusual feature of Witan. Moving on, I won't dwell too much on the top 20 there. The names are very different from the top 20 in the global index, partly because a number of those holdings are some of the funds we just saw on the previous page, and partly simply because our active managers have chosen stocks that are away from the mainstream. The top 20 only amount to 30% of our portfolio as a whole. We have approximately 250 other holdings, which I suppose underlines the point that we are very diversified. We try to make sure that diversification doesn't turn into what somebody called diversification, that you have so much diversity that you can't deliver returns ahead of your benchmark. When I joined, we had about 1,300 stocks, and now we have about 250. So the number of stocks is less important than whether they are thematically concentrated, because you could have 3 companies in a similar sector which will be driven by similar factors. What you don't want to have is a stock in every sector, in every market, because otherwise you're just going to have a very complicated index fund. That's the risk anyway. Moving on to look at 1 or 2 more detailed aspects of the portfolio quickly. We are total return investors, but we do aim to deliver a growing dividend over time, and we have grown our dividend every year since 1974, when I was still at university. Over the past year, we've grown at just over 9.5%. That's probably going to slow down given the hit to market dividends from the pandemic, but we are prepared to use our revenues reserves to continue to support dividend growth in the future while cover from revenue rebuilds. One of the things investment trusts can do is to try and enhance returns by using borrowings. Obviously, that can cut both ways, and this chart shows that quite well, that the blue bars show the net contribution to our returns from gearing after the costs of gearing, and in more years than not, it's been a benefit, and cumulatively, it's been a significant benefit over time. And this year, although it's not yet finished, it has also been a significant benefit to our returns. So that's a plus. We manage it judiciously because, as you can see, in years like 2011, 2018, like taking your eye off an errant Jack Russell Terrier, it can bite you in the ankle. But we are attentive to the benefit of using this. And the other side is the pink line shows the cost of our interest charges as a percentage of NAV, and it's fallen from just under 1% a decade ago to under 0.5%. As we've over time, partly because the assets have grown, partly because we've refinanced our debt, which used to have interest rates of about 7 or 8% to an average rate of under 3%. And the attraction of that is in the medium term, it reduces the hurdle, the profit, the return you need to make in order to deploy this gearing profitably is now effectively 3%, not 7%. So we're hopeful that this debt, some of which is very long term, 30 odd years, will continue to deliver benefits for our shareholders. Long-term performance, won't dwell too much on that because, as we know, you can't enjoy past performance. You either have to suffer or enjoy future performance. But the table there shows that over 10 years we have our benchmark has approximately doubled. We've done a little bit less than 1% a year better than that. So a respectable performance, but not something that we would crow about. We'd like to do better. And the reason it's not as good as it was a few years ago is the last 4 or 5 years have been a slightly spottier record. We had several of our managers had exposures to the UK in the years following the Brexit referendum, and the UK was obviously in the investment shade because of the interminable discussions and political instability as we tried to hammer out a deal. That has shown signs of turning around over the last year, but as we've seen with all the takeover activity in the UK, there's still a perception that the UK is languishing, and there's partly as a result of that. The other reason was that we were caught on the wrong foot at the first couple of months of last year by the pandemic. Some of the beginning of last year, most people expected a year of moderate economic recovery, and they were positioned for that. And obviously the pandemic slammed that into reverse. We were also in the middle of changing our benchmark to something that was more US centric, and we were only partly through that, and the US market ran away from us just when we needed to have more exposure to it. Happily, over the last, as you can see from the first column, the slightly grotty performance over 3 and 5 years has turned around significantly over the past year, with all the usual caveats associated to comments of that nature. And this chart shows that pictorially. Of course, investment can't be guaranteed, it will vary in the future and can't be guaranteed. Looking at the next aspect, the discount matters to us, and it matters to us because it also matters to our shareholders. It's all very well saying you're doing well with the NAV, but people buy and sell the shares. And we can't really control the sentiment and economic factors that might have a bearing on the discount, but we have an established record of actively buying back our shares when they're at a material discount. We bought back 5 or 6% this year. We bought back over 7% last year. And the reason we do it is partly because it's the right thing to do in terms of responding to discount volatility. It has a beneficial effect because you're obviously introducing an extra buyer into the market. The discount should be less volatile, and other things being equal, lower than if you didn't do it. And more tangibly, it's accretive to the NAV. Last year, our buyback activity added about £9 million to our NAV, which by coincidence was almost exactly the same as the investment management fees we paid to our external stock pickers. So it's as well as being the right thing to do for shareholders, it is financially beneficial. Moving on, this just shows the performance by individual year over the last 5 years. The second last column just highlights the period when we were caught out by the first couple of months of the pandemic, and performed quite poorly in February, March last year. And then the final column shows, broadly speaking, that the last year or so we've offset that accident, and obviously I'm the team are very focused on maintaining that improvement. Finally, just a quick comment on how the future looks. Well, economies, as we know, are reopening at a different pace, different timing, because different governments have got different attitudes to these things, and places like Asia have, for example, their vaccination cycle, their infection cycle has been out of step with that in the North Atlantic markets. But by and large, the world is now reopening, and thanks to the brilliant science of a number of universities and companies around the world. And so hopefully the sort of, in some ways, the tragedy of the pandemic may, touching wood, become drawing to an end. But as this reopening is happening, it's against a background where interest rates are near record lows. Fiscal policy is still very stimulative, not as much as earlier in the year when government was doling out largesse to protect people from the impacts of lockdowns, but still an environment of reopening against low interest rates, fiscal stimulus is, we think, good for corporate profits. Clearly, there are two flies in the ointment, really. One is that ratings of some parts of the market are very high, and ratings of even the cheaper parts of the market are more optimistic than they were at the start of the year. And secondly, as we've seen recently, the disruption from the pandemic has led to effectively shortages and inflationary pressures in a number of sectors. The well-meaning and I think necessary change from fossil fuels towards renewable fuels in the medium term has the short-term unintended impact of creating shortages and price increases in energy costs, because we're not rolling out renewable capacity at the same pace as sources of fossil fuel are drying up relative to the demand for them. So there are a few frictions going along with inflation. I think inflation is clearly higher than in recent years, but 10 years ago inflation was 4 or 5% for 2 years in the UK, so I don't think we should be too concerned about that. And more to the point, I expect inflation will be higher in the next few years than over the last decade or so, but it's pretty clear that governments and central banks are not going to overreact they're not going to, as soon as inflation hits 2.1%, start tightening policy. So I see an environment where we will have higher inflation, perhaps similar to the 3 or 4% we had in the 80s, but economic growth was just fine in the 80s. So our medium term, despite caveats of lots of risks, load of things that could go wrong, I see an environment where you have a little bit more pricing power from the higher inflation, relatively high economic growth, because there's agendas like the climate change agenda, infrastructure, and the sort of build back better or build back beaver, or however you want to put it. And against that background, that should be a supportive environment for equity markets, given that interest rates, I think, are going to be stopped from going up too rapidly. So we're fully invested, but we're pretty selective, and just putting a plug in for active management. The thing with active management is you can choose what you want to own within the market. You don't have to hold the bits that you think are going to become obsolescent. Now, obviously, getting it right is the hard bit, but so we're cautiously optimistic, fully invested. Thank you for listening to my introductory comments, and I will now close down.